Hey everyone, Ryan Bolton here. I am a mortgage nerd with Patriot Home Mortgage in St. George, Utah. I really enjoy what I do for a living and I love doing these Q&A videos. I don't ever pre-screen them. I just find questions from either comments or jump onto Quora or Yahoo Answers or wherever the questions might be and just have a lot of fun just answering the questions and see if they're useful for you. So if you like them, please like and subscribe. Please share the video. If you have any specific questions, reach out to me or comment on the videos and I'll get those out on future videos. So I like to keep these videos about 20 minutes or so. So just give you an idea and try to see how many questions we can answer during that time. So let's just jump right in. Let's see what's on the docket for today. This first one I've always liked. It's a pretty common question. There's like the most common questions I see is, can I get a mortgage with a bad credit and should I pay off my mortgage? Those seem to be very common questions that a lot of people have to ask. So this one is phrased a little differently, and that's why I wanted to bring it up. Is it advisable to pay off your home loan in full, or is it better to keep some equity in case of emergencies? It's interesting because when you pay it off, you're actually increasing your equity. So it's kind of a weird way to phrase it, but what I find interesting is you can't get to your equity in case of emergency. If you really needed access to your funds, the only way you get to the equity is selling or refinancing. And anybody that's gone through loans and lines of credit and all this, they're not quick. It's not like you can walk into the bank and just pull out your equity. There's an approval process, there's appraisal, there's loans, there's paperwork, there's pay stubs, W-2s, all that. Now, if you're in an emergency, it's typically not the quickest way to get your money. Now, it's better rates and terms than lines of credit or other quicker ways of getting money. Absolutely. So if you have the time to do a mortgage or do a line of credit or sell the property, that'll be your best interest rates. But it's not the best place to put emergency money as equity because you can't get to it without selling or refinancing the home. So I'm a big believer that you should have savings, emergency, pay off other debts. The mortgage really should be the last thing you pay off. Now, a lot of people are getting ready to retire. Like I see other questions on here that should I use my 401k to pay off my $130,000 mortgage? And I look at that and say, I don't think that's the best use of the money. If you had the mortgage payment covered for the next 10 years, 20 years in the bank, is that better than 100% ownership or just having no mortgage payment? I think you're better off with the cash. Not only do you get a better rate of return typically, but you have more control over those funds if you really do need to get to them in case of emergency. Now, there's a fine line between budgeting and making sure you don't just spend the money and all of a sudden you're out of money and you don't have the equity. So there's some discipline, there's some systems you need to work. But more often when I sit down with the client, I say, don't put as much money down, save the money in your accounts. And there's ways we can structure that to make it more of a full financial plan than just having the house free and clear. A lot of people move to Southern Utah and they have a bunch of down payment from selling a house and they just say, I'm going to put all the money down. And almost every single time I sit down with them and say, let's make that money go further. Let's pay off all the other debts. So all you have is the house payment. Let's put enough money in the bank where you don't have a house payment for the next 10 years, even if you don't put any extra money into it and get a 0% rate of return. There's just better ways to use that money than just having the house free and clear. Now, if you or a family member, parents are getting ready to retire and they have some questions on what they should do, I'd love to talk to them and run specific numbers with their scenario and show them better ways to do it. Now, maybe it is better just to pay off the house. I'm not saying that shouldn't be an option, but I don't think it should be the first option. I think there's ways you can look at the money to make it go further, last longer, more secure, safer. You become your own bank in a lot of ways where you don't have to rely on a refinance or something like that. And I had a client that the husband worked like crazy hard overtime, did all this stuff for like 5 years, just broke his back to get rid of that mortgage payment when he retired. And the sad thing is he made like 3 years later and passed away. So he had a free and clear house for 3 years. Then his wife had all this equity. Great. But she didn't have a job. She was living on Social Security and pension, and she had all this equity she couldn't get to. It's like, would you have rather had your wife had a $200,000 mortgage, but $400,000 in the bank or $250,000 in the bank? I think that's a safer financial plan if it's done correctly, and versus just having all this equity you can't get to. So, or you have to do a reverse mortgage or something like that, which that still is a great vehicle. That's a great loan for the use of it. But there might be other ways that you can look at a longer term plan and diversify that risk by keeping the mortgage and not paying it off, especially if you have a lower interest rate. If you got a 3, 4, 5% interest rate, why would you pay that off versus any other interest rate you have on any other debts, or just having access to the funds? I'm seeing savings and money market accounts that are getting in the 4 and 5% range, just sitting in the account, like pretty low risk investments. So I just think there's better places to put that money. Let's go on to a couple more questions here. What else we got? Do mortgage rates vary by state in the US? Yes. If you have the same scenario. So interest rates are going to be much more based on loan to value, property occupancy, credit scores, debt ratio. That's really going to determine the interest rate. But if you have the exact same scenario, there will be some states that will be a little bit different because of either higher risk of foreclosure or higher insurance issues. There's things that can kind of differ based on risk. So mortgage loans really are a risk. It's kind of like insurance in a lot of ways. The lower the risk, the lower the interest rate. So certain states are going to be higher risk for foreclosure, higher risk for other issues. And so there will see little different rates in regions, maybe not even so much states, but kind of regions will have different interest rates because of just higher risk, higher chance of foreclosure. That's what's going to be typical, but it's not a huge difference, but there will be little difference in interest rates depending on the state if the scenarios are exactly the same. All right, what else we got? We're only 6 minutes in so far. Boy, I feel like I've already talked your ears off. I get talking too quick. I know. I've got this on my desk. Look at this thing. I don't know if you can see this. It's probably backwards on the screen, but it says 2 ears, 1 mouth. I just got to talk slower. I just get excited. All right, let's see what else we got here. What steps should I follow to sell my property to a buyer who's taking a housing loan? So, as a seller, there's really not too much you have to worry about as far as steps that you have to take, other than just being really aware of the deadlines in the contract. Also, what I think is beneficial is when you get that offer, you typically will have a pre-approval letter. If you don't, then you really should before you accept the offer. But you'll get a pre-approval letter from the loan officer, from the mortgage company that says they're pre-approved for XYZ loan or loan amount or whatever it is. It doesn't hurt to reach out to that company and just follow up and make sure they're on their deadlines, make sure that the financing appraisal is good. I mean, they can't give you any private information like the rate they're getting or anything like that, but they at least be able to give you an update that, yeah, we're looking good, we're meeting the deadlines. It's just good to be in communication with the team associated with doing this transaction. The last thing you want to do is get 30 days down the road under contract, and all of a sudden they have to pull their offer because they didn't get their financing or there's some issue. So it's just good to kind of make sure that you're on top of those deadlines, because until those deadlines pass, you usually don't get to keep the earnest money deposit. Now, certain states you get it back no matter what. So it depends on the state that you're in. But a lot of times that security deposit can be refunded to the buyer if they cancel before those deadlines. So knowing those deadlines, mark them on a calendar, give them a call to the lender a couple days before the deadlines, just make sure everything's on track. One of the other things you want to be aware of is the settlement deadline. 3 days before that, 3 business days, so now counting Sunday or federal holidays, us as lenders need to send out a final closing disclosure to the buyer. This is breaking down the final interest rate, final loan amount, final payment, any changes during the process, appraisals, all that stuff. We have to issue this final disclosure 3 days before the buyer can sign. And if they haven't issued that and your settlement deadline's tomorrow, you're not signing on time. So just be aware of that deadline has to be before the settlement, or you're going to have to extend your contract. So I always like to look at the calendar, even go 3 or 4 days before the settlement deadline, kind of mark my calendar, make sure we're on track for that, to make sure that that form gets issued so we don't have a delay of just waiting those 3 days. So just being aware of financing appraisal deadline, settlement deadline, and having some communication with the buyer's loan officer is not a bad thing as a seller. Just to make sure you're not just surprised 30 days down the road, they back out, now you're back on the market, you have to refund the earnest money, and you missed out on all these other buyers. So just have that communication with the lender can save you a little hassle down the road. What are the key steps in securing a mortgage if you have bad credit? Boy, such a common question. I bet you every time I popped open these question screens, it's one of the more common ones is getting a mortgage with bad credit. So you can get a mortgage with bad credit. You don't have to have perfect credit. Now, the worse it is, the worse the terms, down payment, there's things that are worse. But I have had so many times where I'm like, let's get your credit fixed. Let's work on improving your credit so you're getting a better loan. That way you don't have to take a higher interest rate or more money down, or your buying power just gets zapped because you have bad credit. There's ways you can fix your credit. Most mortgages are on 20-point tiers. So you get a better loan from 620 to 640. And it's not crazy hard to go from 620 to 640. Now, if you're trying to get in the 700s, that's where it's going to take a lot more time, a lot more effort to get it cleaned up. But instead of just trying to get any loan that happens with bad credit, work on your credit. Start today. If you're thinking about buying a house in the next 3 to 6 months and you know your credit isn't where it needs to be, then that's where the first conversation ought to be with the loan officer. I'd love to talk to you about it. I'd love to do a free review and say, hey, go do XYZ to your credit and you'll get better loans. That's really where you should be starting. It's not just trying to fit your bad credit into a mortgage. Try to get your credit better so you get better mortgages. And credit's tied to everything. Insurance, car loans, jobs. There's so many things that if you have your credit in better standing and know why your score is the way it is, it'll help you in your financial picture for years to come. So if you need a free review, I'd love to help you with it. I'd love to give you pointers on how to get your score up and set you on a path to homeownership or just better credit in general. But you don't have to have perfect credit to get a mortgage. Usually 620 is a good number. I know loans go down to even 580 credit scores, but usually down payments kick up and the rates kick up. It's so much better if you can get to 620, and that's not crazy. The next big tier with some of these programs seems to be around 660, then 680, 700. So they're in these 20-point tiers, but working towards 660 as a goal is way better than just trying to fit into a mortgage that'll take it. I mean, there's people that loan you money for anything, title loans, mortgage. They'll loan you the money with bad credit, but why not work on the credit first, or at least find out why the score is the way it is and how long it would take to get it fixed? Maybe you got to pay off some bills, you got to deal with some stuff, you put your head in the sand on some old medical collections or something, and you don't want to have to deal with all that, but I'm telling you, it's worth it. If you can save on your interest rates, save on your down payment, get into more of the home you want because the rate's cheaper, it's worth spending 2 or 3 months to fix the credit. And I'd love to help you with that. So check out my website, ryanbolton.com, set up an appointment. I can talk to you. Doesn't have to be in Utah, Nevada. That's where I do most of my lending. I can help you with anything credit oriented to help you on the path to home ownership. And I'd love to help you with that. All right, let's see what else we got here. I hope you find this information useful. Please like, subscribe, click, all that fun stuff. All right. Oh, here's a good question. When would it be a good time to buy a house? Here's the answer. The best time to buy a house was 6 months ago. It really was. So there's no way to really time it. It's not so much timing it, it's timing the market is just really tough. It's not timing the market, it's time in the market. Does that make sense? So it's not timing the market, it's time in the market. So the longer you're in that home, the more appreciation, the more tax benefits you're going to get, the more appreciation and pride of home ownership. There's so many things that kick in on owning a home. So I think you're better off to do it sooner than later. So the best time to buy a house was 6 months ago. The next best time is right now because things will change in 6 months from now. Either interest rates, availability, that price, the home will be available, the price will go up, something's going to change, and there'll be things for the worse and things maybe for the better. So timing it perfectly just doesn't exist. If the home works for your budget today, buy the house. Pure and simple. If it works on the budget, you can get approved, buy it now. You can always turn it in a rental. You can always sell it down the road. It's better than renting. Buy a house. Maybe you got to settle. Maybe you got to move a little further. Maybe what fits your budget, you need a co-signer and team up with a brother, sister, friend, or something on the first home. It's worth it. I'm telling you, it's worth it. There's nobody, I don't think anybody has regretted owning a home in the last 10 years. And even in the last 50 years, even during the 2008 financial crisis that washed over us for a couple of years, was still a good time. There's still opportunities that were in there. And a lot of it just comes down to you got to have housing, and rental versus owning, you're better off to own. Long term, you are better off to own. So buy a house as quick as you can. Why did the average rate on the 30-year fixed mortgage decline in the U.S.? Some of it is the inflation numbers getting better. Some of it is the market doing better. A lot of mortgage-backed securities, the bond market determines interest rates. And as demand for that changes, that's where interest rates can change along that ebb and flow of the market. So it's market-driven. And we're just seeing more pressure to be able to move rates down than having to keep them up. There's still a lot of talk of the Fed's lowering the interest rates as well, which doesn't tie so much in the mortgage, but it's a general idea where the economy is going. So there's just the cost for the money has been able to come down from where it was. So it's a market-driven thing. It really is. How do you best determine the name of a squatter living on your property? Ooh, what's the best? How do you best determine the name of a squatter living on your property? Wow, that's an interesting one. I don't know. I guess ask them. Ask for their ID. Boy, that's tough. I tell you, squatters, it's just tough. There's so many laws, especially in certain parts of the country, that has made it really tough for real estate investors. And obviously, there's an ebb and flow. You don't want it so easy on renters that makes it hard for people to want to invest and buy properties and have rentals. There's certain parts of the country that investors are just not buying property there. because they're like, it's so hard to get rid of anybody. There's so many laws that protect them that it's just, I don't have any recourse if something goes wrong. They can make their first payment and then not make another payment. I've got to make a mortgage payment, and they're just sitting there ruining the property. And I can't do anything about it. And the other time, there's maybe too easy where the landlords can do whatever they want with the property and there's not protections. I would say more protections around the country are protecting renters than the investors, but we've definitely seen it kind of move in some states way too aggressively bad for investors. And I don't think that's a good thing either. I think there has to be a balance between consumer protections and investor protections that have to be there. But I've seen these situations where squatters just stay there for a year. So imagine if you had a mortgage payment on a property, rental property, and you've had to make the $2,000 a month mortgage payment, and somebody's been living in the house and they haven't paid anything. And they usually don't keep up the home as well. They don't maintain it as well. They get pretty ugly, and it just is a bad stain on real estate investing. And it is one of the risks of being a real estate investor. But there's certain states that just make it way hard to get rid of people that just don't make their payments and they just assume they can stay there. They turn it into some sort of human right that they get to stay in your house for no reason. It's an ugly situation sometimes, and I just avoid some of those states that just have those laws that just make it very difficult to evict people. And you don't make your payment, you can't stay. I no pay, no stay. That I don't see why that is such a hard thing to do. And the excuses that people come up with are horrible. I know life happens, medical happens, job losses. I get it. That's tough. But just to be able to stay there without any kind of payment, without helping at all, I mean, I just think it's so unreasonable. All right, let's see what we got here. Another 5 minutes or so. Is it possible to get approved for a mortgage loan with only rental income? Yes. So there's some nuance with that. If you have a bunch of rental income, you can use that to offset any payments you have on your debt ratio. And if you qualify for the new loan, then you would qualify off of rental income. So it depends on how much rental income we're talking about. Now, if it's only on one property, you're just trying to qualify on the rental income you're receiving, yes. There's loans known as DSCR, which is basically a debt servicing loan. So if the mortgage payment is $2,000 and the rent's $2,000, the lender will do that loan. Now, it typically requires a lot more money down, usually in that 25 to 30% range. The rates are going to be higher than you would see if you provided tax returns and W-2s and things like that. But it is a smoother, easier loan that basically says, hey, if the property cash flows, if the mortgage is covered by the rent, we will then do that loan with enough down payment. Now, if you have a positive ratio, you'll see better rates. So let's say the rent is 1.25% or 1.25% above the rent, then you'll see better rates. But I've actually started seeing even lenders that'll go under 1-to-1. You'll see a 0.75 rent received and the mortgage is over that by 25%. You'll actually see lenders that will do it. Again, more down payments required, higher credit scores, higher interest rates. But you can do these loans that don't require 2-year tax returns or pay stubs, W-2s, people that are self-employed or have a lot of rental income, have a lot of businesses and don't want to sit there and go through every single tax return over the last 2 years. So there is a need for that type of loan. And it makes sense. If you got a guy with a 740 credit score, the property cash flows, he's got 30% down, yeah, do that loan. That's a make sense loan. So there are loans, the abbreviation, very big in our industry, is DSCR. It's a debt servicing loan. All right, let's see how else we got here. We've got maybe a couple more we can fit in here. I like to keep these again about 20 minutes. How do I deal with cash transaction by selling a property? That's where the title company can help you to just coordinate how that gets recorded and how that happens. So you still want to probably talk to a title company. You can talk to a real estate agent or a mortgage company. We can kind of direct you to a good title company. But if they are paying cash for the transaction, you definitely want to make sure things are recorded correctly, that wires happen and that type of thing. So I would definitely get a title company involved. That's probably the best answer there. Is now a good time to sell my home before mortgage rates start to rise? I think there's more pressure for rates to go down, but I think it's a great time to sell. We're still seeing very low inventory, depending on your price range, and I think you're going to see as rates go down, there probably will be some more buyers that'll pop up, so there'll be kind of more of a demand that won't be filled by the supply. So I think it's a really good time to sell. The biggest question is, what are you going to replace it with? Where else are you going to go? Do you have another property as a rental? So kind of what you replace it with is probably the next biggest question. That's why we're not seeing a lot of inventory from used sales, is people can't replace their home. They can't replace their interest rate. You know, they owe $300,000 on the house. It'd be $600,000 just to replace it. So most people are just kind of staying where they're at. And that's why you're seeing just kind of low inventory numbers. And most of the new sales are new homes, new construction homes, especially in our area. You're not seeing a lot of existing home sales because you're seeing just too much of a jump between interest rate and price point. A lot of existing homeowners are just staying where they're at. Now, as we see interest rates go down, we may see that uptick a little bit, but I know a lot of buyers are just kind of waiting for interest rates to get better. So as rates drop, more buyers are going to flood the market, and there's still not a lot of inventory. So if you're a buyer and you're waiting for interest rates to drop, you want to get the ball rolling now, because if the home pops up on the market that you like, you'll be in a better position than if you wait 6 months and there's all of a sudden 10 more buyers for that same house or 100 more buyers for that same house. So I think you're better off to get in now. And if rates do drop a year from now or 2 years from now, well, great. Now you got the lower price on the home and you can still refinance. So you get best of both worlds by doing it now. I think waiting is only going to drive up the price. Yes, maybe the rate goes down. Agree. There's a lot of talk about interest rates going down through the rest of the year, maybe into next year, get the election year over with. There probably is more pressure to move rates down, especially if inflation keeps going down. There's probably is more pressure to move rates down. But if that gets more buyers to the market, now all of a sudden you're competing with a much higher home. Now all of a sudden you're back to a point where the house was 400 when you could have bought it at 7%. Now you can get a rate at 6%, but now it's 500,000 or 450. So you lost 50 grand that you could have gained on appreciation and still refinance to get the lower interest rate. Don't wait to buy real estate. Buy real estate, then wait. That is one of the best sayings I can tell you. Don't wait to buy real estate. Buy real estate, then wait. All right. Ooh, that was what a great way to end. 21 minutes or so. Great way to end. I hope you enjoyed this video. I really like putting them on. If you have questions, comments, concerns, if you need help with a mortgage loan, I'd love to help you. I loan in the states of Utah and Nevada. We got a lot of different states that we're licensed at here at Patriot Home Mortgage. That's just the states that I focus on that I'm licensed. But I'd love an opportunity to work with you, help you with your credit, run scenarios for you, just do a comparison for you. Let's say you're getting rates and terms from another lender and you just want a second opinion. I'm more than willing to help you with that. I really enjoy what I do for a living, and I hope I can earn your business or at least help you with this whole real estate thing. I often tell my clients, you're not supposed to know how all this stuff works. That's why you have me. So check me out at ryanbolton.com. Check out my Facebook, YouTube, and we'll see you on the next video. Thanks, everyone.